I wrote a book called Principles for Dealing with the Changing World Order. In it, I studied the rise and fall of reserve currencies over the last 500 years. The Dutch guilder, the British pound, and now the US dollar. And here's what I learned. Reserve currency status is not permanent. It rises, it peaks, it declines, and eventually it ends. This has happened over and over throughout history. And it's happening again right now with the US dollar. Now, let me be very clear about what I mean. When I say the end of the dollar, I'm not saying the dollar will disappear tomorrow. I'm not saying it will become worthless like the Venezuelan bolivar or the Zimbabwean dollar. What I'm saying is this. The dollar's status as the dominant global reserve currency, the status it has held since 1944, is ending. We're transitioning from a unipolar dollar-dominated system to a multipolar currency system. And this transition, which is already underway in 2026, will have profound implications for your wealth, your investments, and your financial security. The timeline. I believe we're currently 60 to 70% through this transition. It started around 2008 with the financial crisis. It accelerated during COVID with unprecedented money printing. And now, in 2026, we're entering the final phase, what I call the acceleration. Over the next 5 to 10 years, 2026 to 2035, the dollar will lose significant additional ground as the world's reserve currency. Not all of its status, but enough to fundamentally change the global financial system. What this means for you. If you hold most of your wealth in dollar-denominated assets, cash, bonds, stocks traded in dollars, you're exposed to significant currency risk. As the dollar weakens relative to other currencies and hard assets, your purchasing power will decline. But if you understand what's happening and position correctly, you can not only protect yourself, but potentially profit from this historic transition. Today, I want to explain the history, how reserve currencies rise and fall, so you understand the pattern, where we are now, the current state of dollar dominance in 2026. What's coming? The specific timeline and catalyst for continued dollar decline. How to prepare. Concrete steps to protect and position your wealth. This is not abstract economic theory. This is practical guidance for navigating one of the most significant financial transitions in modern history. Let's begin. Before we talk about the dollar specifically, you need to understand the pattern. Because reserve currencies follow a predictable life cycle, once you see the pattern, you can see where we are in the cycle. I've studied every major reserve currency over the last 500 years, and they all follow the same arc. Stage 1. The rise, building dominance. A country becomes a reserve currency power through a combination of factors. Economic strength. They're the most productive, innovative economy. They're creating wealth faster than anyone else. Military power. They can project power globally. They can protect trade routes and enforce contracts. Rule of law. They have reliable institutions, property rights, contract enforcement. People trust that their money is safe there. Deep capital markets. They have sophisticated financial markets where people can easily buy, sell, invest large amounts of capital. This was the Netherlands in the 1600s, Britain in the 1800s, the United States in the 1900s. Stage 2. The peak, dominance. At the peak, the reserve currency country dominates global trade and finance. Most international trade is denominated in their currency. Most countries hold their reserves in that currency. Most debt is issued in that currency. The currency is the global standard of value. For the dollar, this peak was roughly 1950 to 2000. During this period, the dollar was unquestionably dominant. Stage 3. The decline, erosion of dominance. But then, gradually, the factors that created dominance begin to erode. The country accumulates debt. They borrow heavily, often to fund wars or social programs. Debt to GDP rises to unsustainable levels. They print money. To service the debt and avoid painful austerity, they debase the currency. Inflation results. Productivity declines. They lose their innovation edge. Other countries become more competitive. Military overextension. They maintain expensive military commitments globally, draining resources. Internal conflict. Political polarization, social unrest, institutional decay. The country becomes less stable. This happened to the Netherlands in the 1700s as Britain rose. It happened to Britain in the early 1900s as the U.S. rose. And it's happening to the U.S. now as we transition to a multipolar world. Stage 4. The transition, new order emerges. Eventually, a new reserve currency, or currencies, emerges to replace the old. The Dutch guilder gave way to the British pound around 1720. The British pound gave way to the U.S. dollar around 1944 after World War II. The U.S. dollar is giving way to a multipolar system, 2026 to 2035. What's different this time? In previous transitions, there was a clear successor. The pound replaced the guilder. The dollar replaced the pound. But this time, there's no single obvious successor. China's renminbi is too controlled, too opaque. Europe's euro has structural problems. So instead of one replacement, we're getting a multipolar system. The dollar, diminished but still significant. The euro, the renminbi, Chinese yuan, possibly gold or commodity-backed currencies. Potentially digital currencies, central bank digital currencies. The key insight: we are in stage 3 to 4 right now. The dollar is declining. The transition is underway, and the pace is accelerating. Understanding this pattern is critical because it tells you what comes next and how to position. Let me give you the current state of the dollar as we sit here in 2026. The data shows clear erosion of dollar dominance. Reserve holdings. 2000. The dollar represented about 71% of global foreign exchange reserves. 2010, down to about 62%. 2020, down to about 59%. 2026, current approximately 55 to 56%. That's a loss of 15 percentage points over 26 years. And the pace is accelerating. Where did that 15% go? Euro gained some. Renminbi, Chinese yuan, gained some. Gold increased, central banks buying record amounts. Other currencies, Canadian dollar, Australian dollar, Swiss franc, gained small shares. Trade settlement. Increasingly, countries are settling trade in currencies other than the dollar. China-Russia trade, now primarily settled in renminbi and rubles, not dollars. China-Saudi Arabia, beginning to settle some oil purchases in renminbi. This is huge. Oil has been dollar-denominated since the 1970s. India-Russia, settling energy trade in rupees and rubles. BRICS nations, exploring common currency for trade settlement. This is a fundamental shift. For decades, if you wanted to buy oil, you needed dollars. Now, increasingly, you don't. U.S. debt and deficits. Total U.S. government debt, 2026 over $36 trillion. Debt to GDP ratio, 120% plus. Annual deficit, running $2 trillion plus annually. Interest payments, over $1 trillion per year, exceeding defense spending. These numbers are unsustainable, and the world knows it. Foreign holdings of U.S. debt. China has been reducing holdings from peak of $1.3 trillion to under $800 billion currently. Japan, still largest holder, but not increasing. Saudi Arabia and Gulf states, diversifying away from pure dollar holdings. Foreign appetite for U.S. debt is waning. This is a critical warning sign. Money printing, Federal Reserve balance sheet. 2008, $900 billion. 2020, $4 trillion. 2022, peaked at $9 trillion. 2026, currently around $7.5 trillion, reduced but still enormous. The Fed printed more money in 2020 to 2021 than in the entire previous history of the United States. That has consequences. Inflation. The 2021 to 2022 inflation spike, reaching 9%, was a direct result of this money printing. Even now, in 2026, inflation remains stubbornly above the Fed's 2% target, sitting at 3 to 3.5%. This persistent inflation erodes the dollar's purchasing power and makes foreign holders question whether dollars are a reliable store of value. Geopolitical developments. BRICS expansion. Brazil, Russia, India, China, South Africa have expanded to include Saudi Arabia, UAE, Egypt, Ethiopia, Iran. This bloc represents about 45% of global population and 35% of global GDP. They're actively working to reduce dollar dependence. Commodity pricing. More oil and gas being priced in non-dollar currencies. Payment systems. China's CIPS, Cross-Border Interbank Payment System, is an alternative to SWIFT, reducing dollar necessity. What this all means, as of 2026, the dollar is still the dominant reserve currency, but its dominance is clearly eroding. We're about 60 to 70% through the transition from peak dollar dominance to a multipolar currency world. The question is not if this transition continues, but how fast it accelerates over the next 5 to 10 years. Based on historical patterns and current trajectories, let me walk through what I expect over the next 5 to 10 years. 2026 to 2027, continued gradual erosion. What's happening? Dollar share of global reserves continues falling toward 50 to 52%. More bilateral trade settled in non-dollar currencies. BRICS formalized mechanisms for non-dollar trade. U.S. continues running large deficits, accumulating debt. Catalyst potential. If the U.S. enters recession in 2026 to 2027, which I think is likely, the Fed will respond with rate cuts and potentially more QE, money printing. This would accelerate dollar weakness. Impact on dollar. Gradual depreciation against basket of currencies, 3 to 5% annually. Purchasing power erosion. Not a crisis, but steady decline. 2028 to 2030, acceleration phase. This is where I expect the transition to accelerate significantly. Potential catalysts. 1. U.S. debt crisis. At some point, likely in this time frame, the U.S. faces a debt sustainability crisis. Interest payments become so large that they crowd out other spending. Political battles over debt ceiling become increasingly severe. To avoid default, the Fed is forced to monetize more debt by government bonds with printed money. This is inflationary and damages dollar credibility. 2. BRICS alternative currency launch. The BRICS nations could launch a commodity-backed trade currency or digital currency, initially for trade settlement among member nations, but potentially expanding. If backed by gold or a basket of commodities, this could be attractive to countries wanting to reduce dollar exposure. 3. Oil pricing shift. If Saudi Arabia and other major oil producers significantly expand non-dollar oil pricing, already happening on small scale, this would be a major blow to dollar demand. Oil has been the foundation of dollar dominance since the 1970s petrodollar system. 4. Geopolitical crisis. A major conflict, Taiwan, Middle East, Eastern Europe, could trigger rapid shifts away from dollar as countries choose sides and seek currency independence from U.S.-dominated financial system. What this means for the dollar. In this phase, dollar depreciation accelerates. Against major currencies, 5 to 10% annually. Against gold, potentially 10 to 15% annually. Against basket of commodities, 7 to 12% annually. This is when dollar holders feel real pain. 2031 to 2035, the new equilibrium. By the early to mid-2030s, a new equilibrium emerges. The multipolar currency world. Dollar, 35 to 40% of global reserves, down from 55% in 2026. Euro, 25 to 30%. Renminbi, 15 to 20%. Gold and commodity-backed currencies, 10 to 15%. Other currencies, 10%. What this looks like. The dollar remains important, but is no longer the dominant currency. It's one of several major currencies. International trade is settled in multiple currencies depending on the parties involved. There's no single global standard. Central banks hold diversified reserves across multiple currencies and gold. For the average American, this transition means imported goods become more expensive, declining dollar equals higher import costs. International travel more expensive, but potentially some benefits. U.S. exports become more competitive. For investors globally, this is a historic wealth transfer from dollar-denominated assets to hard assets and alternative currencies. The speed of transition. Here's the critical question. Will this transition be gradual and managed, or sudden and chaotic? Gradual scenario, 60% probability. The transition plays out over 10 to 15 years, 2026 to 2040, with steady but not catastrophic dollar decline. Gives people time to adjust. This is manageable. Sudden scenario, 40% probability. A crisis triggers rapid dollar selling. Confidence collapses. In 1 to 3 years, the dollar falls 30 to 40% against major currencies and gold. This is catastrophic for unprepared dollar holders. I can't tell you which scenario we'll get, but I can tell you that either way, if you're heavily concentrated in dollar assets, you're at significant risk. All right, let's get practical. How do you protect yourself from dollar decline and position to potentially profit from this transition? Strategy 1. Diversify across currencies. Don't hold 100% of your wealth in dollars. Diversify across multiple major currencies. Target allocation: 40 to 50% US dollar assets, 20 to 25% euro-denominated assets, 10 to 15% Asian currencies, renminbi, yen, Singapore dollar, 10 to 15% commodity currency exposure, Australian dollar, Canadian dollar, Norwegian krone, 10 to 15% gold, the ultimate currency-neutral asset. How to implement. Option 1. Foreign currency bank accounts. Some international banks allow you to hold accounts in multiple currencies. You can keep euros, pounds, Swiss francs, etc. Pros: direct currency exposure, liquid, simple. Cons: often requires minimum balances, may have fees, no investment returns. Option 2. Currency ETFs. ETFs that hold foreign currencies. FXE, Euro ETF. FXY, Japanese Yen ETF. FXA, Australian Dollar ETF. FXC, Canadian Dollar ETF. Pros: easy to buy sell, low minimums, liquid. Cons: tracking errors, management fees. Option 3. Foreign stocks and bonds. When you buy European or Asian stocks/bonds, you're inherently getting currency exposure, if unhedged. Example: you buy a German stock trading in euros. If the stock stays flat, but the euro rises 10% against the dollar, you make 10% in dollar terms. Pros: dual exposure, asset plus currency, potentially higher returns. Cons: more complex, more volatility, need to understand foreign markets. My recommendation: combine approaches. 20 to 25% in foreign stocks, international equity funds, unhedged. 10 to 15% in foreign bonds, international bond funds, unhedged. 10 to 15% in gold, the ultimate non-currency asset. Strategy 2. Increase gold allocation significantly. Gold is unique. It's not any country's currency, so it's not subject to any single government's monetary policy. When all major currencies are being debased, printed excessively, gold tends to hold its value against the basket. Target allocation: 15 to 25% in gold. This is much higher than the typical 5 to 10% I usually recommend. But we're not in typical times. Currency transition periods favor gold. How to own gold. Physical gold: 5 to 10% of total portfolio. Gold coins: American Eagles, Canadian Maple Leafs. Gold bars, if you have significant wealth. Store some at home, small amount, most in secure storage facility. Gold ETFs: 10 to 15% of total portfolio. GLD, SPDR Gold Shares. IU, iShares Gold Trust. These hold physical gold. You own shares. Gold mining stocks, optional, 0 to 5%. More leverage play on gold prices. GDX, VanEck Gold Miners ETF. Higher risk/return than physical gold. Strategy 3. Invest in hard assets. In currency transitions, hard assets, real physical things, tend to hold value better than financial assets. Real estate, particularly international real estate. If you can afford it, owning property in stable countries outside the US gives you currency diversification. Hard asset, potential rental income. Commodities, energy, oil, natural gas. Industrial metals, copper, aluminum. Agricultural commodities, wheat, corn, soybeans. How to invest. Commodity ETFs, DBC, GSG. Energy stocks, XLE. Commodity producing country stocks. Strategy 4. Invest in productive businesses. Own companies that produce real value, generate real cash flows, and have the ability to raise prices with inflation/currency debasement. Focus on companies with international revenue. U.S. companies that earn significant revenue abroad. When the dollar weakens, their foreign earnings are worth more in dollar terms. Companies with pricing power. Brands and monopolies that can raise prices without losing customers. They can pass currency debasement costs to consumers. Companies in strategic industries. Energy, food production, critical materials, technology infrastructure. These tend to hold value through currency transitions. Specific examples. Multinational companies, Apple, Microsoft, Google, earn globally. Energy majors, ExxonMobil, Chevron. Consumer staples with global reach, Coca-Cola, Procter & Gamble. Infrastructure and utilities, regulated businesses with pricing power. Strategy 5. Reduce dollar-denominated long-term fixed income. This is critical. Long-term bonds denominated in dollars are extremely vulnerable. Why? If dollar declines 20 to 30% over next 5 to 10 years, and you're locked into a 30-year bond paying 4 to 5%, you're losing purchasing power every year. What to do? Exit. Long-term treasury bonds, 10+ years. Long-term corporate bonds. Any fixed-rate dollar instrument with maturity beyond 5 years. Replace with short-term bonds, 1 to 3 years. You can reinvest at higher rates if rates rise. Tips: inflation protected. At least these adjust for inflation. Foreign currency bonds, if you believe those currencies will strengthen versus dollar. Floating rate bonds. Rates adjust as interest rates change. Strategy 6. Consider cryptocurrency carefully. I'm not a crypto maximalist, but I do recognize that Bitcoin and other cryptocurrencies are, in part, a bet against fiat currency debasement. The case for crypto in a dollar decline scenario. Bitcoin is designed to be scarce. Only 21 million will ever exist. Unlike dollars, euros, or any fiat currency, it can't be printed at will by a government. If people lose faith in fiat currencies, some capital could flow to crypto as an alternative store of value. My position: keep crypto allocation small, 2 to 5% maximum of portfolio. Why small? Highly volatile. Unproven in true crisis. We don't know how it performs in major economic collapse. Regulatory risk, governments could restrict. But given the currency transition risk, 2 to 5% in Bitcoin as a hedge is not unreasonable. Strategy 7. Build skills and human capital. Your human capital, your ability to earn income, is also affected by currency transitions. In a dollar decline scenario, if you earn income in dollars but dollars are weakening globally, your purchasing power, especially for international goods, declines. How to protect? Develop globally marketable skills. Skills that allow you to earn in multiple currencies or relocate if needed. Build international network. Contacts and opportunities outside the U.S. Consider remote work. Ability to earn in stronger currencies while living in weaker currency zones. Geographic arbitrage. Learn about international markets. Understanding global finance and business gives you options. All right, let me bring this together with a concrete action plan. Your 90-day currency transition preparation plan. Month 1. Assessment and education week 1. Calculate your current currency exposure, likely 90% plus dollar if you haven't thought about this. Determine your target diversification. Use framework I provided. Read Principles for Dealing with the Changing World Order week 2. Research international brokers or platforms for currency diversification. Study foreign stock/bond markets you're considering. Understand tax implications of foreign investing. Consult tax advisor. Week 3. Create watch list of foreign stocks, bonds, currencies you're interested in. Research gold storage options if going physical route. Review your current bond holdings. Identify long-term dollar bonds to exit. Week 4. Finalize your target allocation across currencies and assets. Create written investment plan. Set timeline for implementation month 2. Implementation begins week 5. Start exiting long-term dollar bonds. Build cash position. You'll redeploy into diversified assets. Week 6. Begin buying gold. 10 to 15% target. Dollar cost average over several weeks. Open international investment accounts if needed. Week 7. Start building foreign stock exposure. International equity funds. Consider foreign bond allocation. Week 8. Add currency ETFs if using that approach. Review progress. Adjust as needed. Month 3. Completion and monitoring. Week 9. Finalize all position building. Confirm you've hit target allocations. Week 10. Setup. Monitoring system. Quarterly reviews. Create rebalancing rules when to adjust allocations. Week 11. Document everything. What you own, why and what amounts. Share plan with family or advisor. Week 12. Final review. Commit to ongoing education about currency markets. Set calendar reminders for quarterly portfolio reviews. The target portfolio. Currency transition resistant. 25% U.S. stocks. Focus on multinationals with pricing power. 20% gold. Physical and ETFs. 20% international. Stocks. European, Asian, emerging markets, unhedged, 15% tips. Inflation protection if dollar inflates away debt. 10% short-term treasuries or cash. Liquidity, low risk. 5% foreign bonds. Euro, Asian currencies. 5% commodities. Energy, materials, total. 100% with significant non-dollar exposure. Key principles. 1. All right, let me bring this together with a concrete action plan. Don't panic, but don't ignore this. The dollar decline is gradual, not overnight. You have time, but that time is limited. Don't wait 5 years. 2. Diversification is protection. You're not trying to perfectly predict which currency wins. You're spreading risk so that no single currency's decline destroys you. 3. Hard assets over financial assets. In currency transitions, gold, real estate, commodities, productive businesses tend to outperform bonds and cash. 4. Stay informed and flexible. Monitor developments. The transition could accelerate or slow. Be ready to adjust. 5. Think in purchasing power, not nominal returns. A 5% return in a currency that declined 10% is actually a loss. Focus on real, inflation, and currency-adjusted returns. What I'm doing personally. I practice what I preach. My personal allocation. Approximately 35% in dollar-denominated assets, down from 80% plus years ago. 25% in gold. 25% in international stocks and bonds. 15% in other currencies and hard assets. I've been reducing dollar concentration for years, and I continue to do so. The big picture. We are living through a historic transition. The dollar's 80-year run as the dominant global reserve currency is ending. Not immediately, not catastrophically, but clearly and irreversibly. If you understand this and position accordingly, you'll protect your wealth and potentially profit. If you ignore this and remain 100% concentrated in dollar assets, you'll watch your purchasing power slowly erode over the next 5 to 10 years. The choice is yours. Subscribe to this channel for ongoing updates on the currency transition and global economic shifts. And remember, empires and reserve currencies don't last forever. But if you understand the pattern, you can navigate the transition successfully. Thank you for watching. Now, go diversify your currency exposure.